Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and today we are coming in. We have lots of things to get into with all the spooky things that have been happening for the month of October so far. We are a little behind on our series. I am getting over my first round. It was my turn to have COVID, so I'm going to do my best to get through this. Talking tends to trigger me to cough, but we really have some exciting and really we think pertinent information to kind of bring to our viewers here. So we're going to go ahead and get into that. So, I'm doing an article right now talking about it's a current rally that we're experiencing, a trick or treat, because up until kind of the movements that we saw early on this week, we've had October's been a very weak month. And so we're going to talk specifically about where some of these moves have been. But we have really just seen markets continue to be under pressure. We were very close to violating some really important levels of support, which thankfully we were able to come back and close above back last Thursday. You may have heard that the CPI numbers, which is really the number that we use to judge how we're doing with inflation, came back hotter than expected again. Now, we didn't miss by much, but it didn't matter. Just being off by that 0.2% that we were, showing that prices were still higher than what was expected, kind of told the market it's likely that the Federal Reserve is not going to be done raising rates right now, because that's the whole idea, that the Federal Reserve is now saying that they are not going to stop until we are able to get inflation under control, which is a double-edged sword. Because yes, we want to be able to see prices begin to fall again, but by doing so, they're going to have to continue to be aggressive with raising rates, as well as continuing to cut back on quantitative easing and those other things that they've been doing to kind of handhold markets for a while here. And so where we were last week, it was a pretty precarious situation, and I think that we were in, from a psychological standpoint, that very dangerous part of a bear market where investors may have been kind of ready to just throw the towel in and say, you know what, I'm out. I'm just going to kind of sell everything and just wait. And then we had this kind of huge rally, this rebound. We saw movements where we opened the day at negative 3% and then closed up almost positive 3%. We saw moves of over 5.5% from open to close in one day. And believe it or not, that was actually the day that the CPI numbers came out. So investors were very negative, very bearish on Thursday. Again, markets opened up down negative 3%. We violated some really important support, which I'm going to show you. But the fact that we were able to come back and close above it, number one, shows that the support held, which for the intermediate and long term, that's a good sign for markets. And then, so that is something we're going to go ahead and get into. We're in the midst of kind of like what's likely a bear market rally right now, where we're seeing some relief. We'll show you where we're at now. So here we're just talking about the S&P 500. And so what I have highlighted here is we have our 20-day moving average. This is actually an important number for today, which we're going to talk about. That's in red. Our 50 days in blue. The 200-day moving average is in that orange color there. And so here we are, we've seen, again, so here we are at the beginning of October, just really been under pressure. This is that sell-off that began on Thursday, where we actually wound up coming back up here and closing up here. And so this 20-day moving average is really acting as our first line of support. So the good news here is that we have finally broken above that. We bounced right off of it. We held it. So right now the 20-day is acting as support for us. Now today, which is Wednesday, markets are down some today, not surprising, because we've had a pretty strong move, almost 4% move in the S&P 500 just from Monday to now, or from Friday to now. So we've seen some pretty big movements there. So not surprising that we're kind of pulling back a little bit today. Again, this 50-day move here, you can see how this 20-day, that is our support that we closed above. Here we bounced off of here. Our next line of support then is going to be the 50-day. And so you can see that after, when we violated the 50-day here, it's kind of been like a straight shot down. If we can close and hold the 20-day as we've done, then our next kind of area of resistance is going to be right at about 3,900, our blue line there. That's our 50-day. If we can close above that and hold that, that would really for the interim, give the all clear, that we could go all the way up to 4,000 on the S&P. That would kind of be like the next feasible level. Now, there's some things kind of going on that's kind of adding to the momentum right now within markets that we'll talk about in just a minute. But just kind of want to show you, so this is where the numbers are. You can see, I mean, again, so back in May, we hit these lows in June. We had that steep sell-off again. And so we actually were down below those June lows just a few days ago. And now we are above those bottoms. So it's really important here that markets can hopefully kind of hold on to that. Then that really will make that previous bottom our new line of support for the bottom at least. So that is, when we look at our moving averages. Now, of course we're not going to. So I haven't talked about this average very much. This is the 200-week moving average. This is a much more long-term average just to kind of look at the trend of the market. And so that's going to be this blue line here, black line is the S&P 500. It's been very few times that we have violated this 200 weekly moving average. So you can see we did violate it for a short term back in 2020, but we actually went right back not long after that. Back in 2008, we violated it here, and so that was the correction 2008 and 9. 2002, we did it again here, and again that was a prolonged bear market situation that we were in, and then again we didn't do it again back until the 80s. So every time, though, that we have broken down through this, it's meant a prolonged bear market, and as you can see, other than 2020 was an anomaly. We did break through, but came back. Well, you can see here, after last week's movement, we did kind of sit right on that. Now we bounced off, and so again, talking about the importance of being able to kind of hold where we are for now really lies important, because if we do break through the 200 week, could absolutely mean that this could potentially be a longer drawn out bear market for us. So kind of watching that very carefully, I thought that was interesting to talk about. And so one thing that people keep asking, well, how do we know if the bottom's in? Now I read some articles again today. Hey, now the bear market bottom is finally in after all these positive movements that we've seen since last week. And I really think that what the markets are waiting for to truly be able to say it's a bottom is that there has to be some type of assurance that the Federal Reserve is going to start backing off of raising rates right now. And that's not going to happen until CPI numbers and economic indicators kind of finally begin to improve. Now they're getting better. So inflation numbers have absolutely been improving, but they haven't been improving as quickly as what was expected. They've been stickier than what we thought. So something that's important also to note is that when the Federal Reserve makes new policy, they tend to be looking at older data. They're looking at data that's lagging. So instead of kind of looking at reports that are in real time today, they're typically looking at statistics from 6 months ago or even 9 months ago. And so, which was interesting, I didn't realize that until I started to do some more research about this. And so that's why it's kind of hard to really know. So that's how policy mistakes sometimes happen as well. And so that we're at a really, I think, critical point where the Federal Reserve really needs to be able to evaluate where we are and not kind of overestimate what needs to be done. They keep still saying that a soft landing is possible. Well, this feels like it's been a pretty hard landing here. So again, I think until we see some reassurances that CPI numbers have improved and that they're going to stay that way, I think that markets are going to continue to kind of to churn in a volatile way. Some other things that I've been keeping an eye on is just retail sales. So especially as we start heading into the holiday season, retail sales is really kind of the temperature test for the health of consumers. And so if spending kind of continues to seem like it's an issue, if we continue to buy less, that's going to be an issue across the board. It's going to tell us that people don't feel confident, but retailers are already dealing with an oversupply of stuff. So we've seen all the articles about it's actually more expensive for a return to be made. If a customer makes a return, they want you to just keep it anyways because they don't have anywhere to hold it. And so I think that it's going to be interesting as we come in the holiday season. Something else is that credit card balances for consumers has climbed substantially, going up, and so we're leveraging ourselves. Again, that's not really the sign of economic growth. When we see these things, it tends to tell us that things may be coming into a slowdown because people are becoming over leveraged. And so sentiment in general is very negative across the board, which actually, if you followed us before, you know that could be an actual bullish or positive marker, because when everybody's on one side of the boat, it usually is a sign that maybe things are going to start tipping the other way. Well, right now, sentiment is absolutely negative. Come back to this. And so here's our fear and greed index. So you know, back in 2020, I mean, we were up off the charts up here. Well, we're all the way down here now. So, which is actually, we're feeling very negative about things right now, which actually may be a good thing. We're actually close to the extreme fear side of things. Remember, extreme greed, that was when we saw a lot of unscrupulous things going on in the market. People were trading GameStop, they were trading AMC. Everybody was like, this is the easiest thing in the world. I can just throw money into the market and I make money. I can quit my job, I'll just day trade all day. That's kind of where we were at the height of things here. So now we're kind of in, now people are like, I don't know what to do. I feel like I should be going to cash. I'm scared, which again, that's really where, when we get to that point, that's where mistakes can certainly be made. That's where it's really important that you follow your investment philosophy, that you follow your process. If you don't have one, that's something that you may want to consider hiring an independent fiduciary to help you with, to make sure, because again, when emotions begin to make our decisions for us, they rarely have the end result that we were hoping for. Now, when we talk in general about just the bond market, we haven't talked about this in a while. Bonds have had an absolutely abysmal year, having the worst year on record for now. And so here's our total bond market index is down over 17%, which is really insane when you think about it, that the S&P 500 is down about 24% for the year, and the total bond market is down 17.5%. High yield's done a little better, down 9.7%, but for an area that's typically a safe haven, we're certainly not getting that this year. Again, it's been just a very strange, difficult year to navigate. And my screen just does not want to work for me today. And so just the last area to kind of talk about, we haven't done this in a couple of weeks, is just areas of strength in the market. And so again, value play just remains to kind of be king. Value is king right now. And we typically see that in times of high inflationary pressures. Growth continues to lag. Energy, consumer non-cyclical, financials, and utilities are all areas of strength. They all kind of go along with that value play. And then our laggards have been real estate, technology, consumer cyclicals are non-discretionary, things that you don't have to buy. Fixed income remains below domestic equities. Commodities in the number one. Cash remains in the number two position, which is interesting. Doesn't happen very often that we see cash in that top three position, but based upon the moves that we've had year to date, that's where we are. And so I think that kind of the takeaway point today, so you can certainly use rallies like we're into right now. You may want to consider, trimming back certain positions as we've seen these rebounds. I think it's likely that there's still going to be some more sloppiness in the markets. One thing that I mentioned that I do want to get into really quick is stock buyback season is coming soon. So as we get closer to Halloween around the 28th, as most of the earnings have been reported, companies from October through the end of the year will be allowed to begin their stock buybacks, purchasing back their own stock. Especially they'll be purchasing it back at a lower price, which actually winds up helping to kind of artificially give a lift to markets. And again, it's coming only because companies are buying it back, but it does overall help markets to increase. And so that will be something to be kind of looking for as we come into the end of October, and then moving into the end of the year. We do typically see some market lift coming in the end of the year, especially money managers are going to need to be repositioning portfolios for the new year soon. Money managers who may have some cash on the sidelines, they're going to have to get that cash off their books, which means they're going to have to distribute that back into areas of the market, which again will provide lifts for markets again. Though I do think that as investors, when we have these rallies that we've seen, you can use them if you have areas of weakness in your portfolio that have just really underperformed. This may be a time to consider trimming back if it's kind of bounced some. That's what's tricky about bear market rallies, is once you see them starting to go back up, then mentally you think, well, maybe I don't want to cut this yet because it's kind of starting to run. Well, that's why it's important to have rules in your portfolio. If they violate any of your rules, you have a process to follow. And then again, if you don't have rules or you don't have a strict investment policy, it's always a good idea to consider talking to an independent fiduciary to kind of help guide you. It's been a challenging year. I think that after we kind of get through this, I think the future still looks very bright when we look at where we are. But we just do still need to kind of get through these hurdles before we can kind of get that all clear. And so I think as investors, we just kind of need to remember that. So as long as you know what positions you're holding and why they're there, that's, you just want to make sure that you have that process. And again, I'm Ashley Rosser. If you have questions, you can always reach out and give me a call or send me an email. We love to help however we can. We'll catch you next time. Have a great week.